welcome to the Trading Zone presented by the MIAX on the Tradier Hub. I'm Joe Teague, Portfolio Manager at Equity Armor Investments, and with me today, like every week, is Brian Stutland. Brian, how are you doing?
How you doing? I'm Brian Stutland, Portfolio Manager at Equity Armor Investments as well. We're here on the Trading Zone. Live coming at you today, Monday. Always tune in here, 1 p.m. Eastern time. But we have a great show today, covering some things on the AI play, along with what's going on with the markets. I think the S&P is having an interesting breakout session this morning, along with the last few trading days, in the wake of some pretty bad economic news. And we'll kind of get into all that, Joe, and more.
Yeah, climbing a wall of worry. Just wanted to point out right now, this very second, let the VIX cracking below 20, Brian, but it's been just a nice grind higher, very melt up market where we're rallying just a little bit this week. It does not look like a market where the VIX would be in the vicinity of 20. So this is pretty unusual.
Yeah, it is very unusual that we could be at all-time highs, breaking out to the upside, and the VIX is also higher. This is starting to look more and more like the 90s, Joe, but obviously there's a lot of bad data out there, and maybe you have some of those headlines.
Yeah, we'll take a look at all of it. Just want to give people just one more minute to tune in. We're just starting the show right now, so just want to give people a second to come in, say hi, tell us what you're up to this weekend. Make sure to check out our website. We got a free ebook there. I see a few people have taken advantage of that recently, so good job for you who have taken advantage of it. You can go on our website, check out Trading with Edge. Great tips about how to be a successful options trader, how to have the mindset of a successful options trader. So make sure you check that out. Again, we're here every week at 1 Eastern. We are former options market makers. We're now portfolio managers and mutual fund managers. And we're using the tools, the tricks, all of the lessons we've learned as options market makers and bringing them to everybody here. And hopefully you get something out of it. But the best way to get something out of it, of course, is to ask questions. So please feel free, ask your questions, send them to us at the show, put them in the comments. We'll get to them as we go along.
Yeah, and like I said, as people kind of tune in here, what we're going to plan on bringing you today is bad economic data, good news for the stock market, a trade for the tech sector coming up, which big earnings, ASML, tune in about how we're playing that and more.
Yeah, looking forward to the show also. So let's get into it. I think that's enough. Let's check out our show for the week. Here we go. This is a Trading Zone. I forgot how to use a computer for a second, Brian. All right, so this is a Trading Zone. I'm Joe Teague with Brian Stutland. And yeah, we talked about the VIX being a 20. I mean, obviously, there's some uncertainty out there in the market, Brian. There are, we had a nice rally a couple of weeks ago on China. China's just been in this absolute tear, but there are some warning signs. Some of their exports growth is not growing as fast as people are saying, or people have thought. Maybe it's a sign of a weaker global economy, weaker economies from Europe and the U.S. Maybe not buying as many Chinese goods. Maybe it's more to do with tariffs from the West. We'll see. It could be either, but here's some other warning signs. We have OPEC saying, hey, the global growth forecast is not as strong as we previously thought. People aren't going to be needing as much oil in the near future because the economy is not growing as strong as we thought. So that's potentially another warning sign. Okay, but that's okay. The Fed's going to be there. They're just going to lower interest rates. All is well, right? Well, actually, last week we had the CPI hotter than expected. Maybe it's not going to be the case that the Fed can be really aggressive and lower rates, but it's okay, Brian, right? Because the jobs growth is there, right? Well, actually, last week we had the jobless claims hotter than expected. So people were filing more unemployment claims, so there are fewer jobs out there. So a lot of warning signs out there, but coming back to reality, though, it really comes down to like how strong the economy actually is. We're just getting this mixed data that sometimes happens when the economy is slowing down. But ultimately, how are the stocks performing? So we're going to have big earnings coming up this week. We're going to trade ASML, as you said, on the top of the show. But it's going to come down to, can these companies meet these expectations? Can this economy sustain these levels?
Well, it looks like all what you laid out is terrible news for the stock market. And if I was reading all those headlines, I would say sell, sell, sell. But this is all allowing a trigger of lower interest rates to be met by the Fed, to valuations being able to be marked higher. And like to your point, it seems like the stock market is pricing in reasonably good earnings, reasonably good GDP growth continuing. And that's the one silver lining, the one positive driving force on all of this that can be pushing the market higher. Also, obviously, we have an election coming up, and it does feel a little bit like a Trump rally is on, as betting markets have sort of shifted in recent last couple of weeks towards Trump winning the election from some of the polls that I'm seeing on some of the betting sites where odds of winning have favored Trump here. And so the rally has been on the stock market side, all taking all this bad news with a grain of salt and saying, well, now the Fed can ease a little bit. Obviously, the one concern that you brought up was the CPI number coming in a little hotter, but it's not crazy. It's around that, just above that 2% annual target rate that the Fed wants to sit at. So that should give some bullets for the Fed to continue to cut rates.
Well, we'll see how that goes. Yeah. So I think with the election, you mentioned Trump now has a slight edge. Before it was a slight deficit. I don't know if that makes a huge difference. If it's Trump 48, Trump 54 to win on the betting markets, that's still a coin toss to me. I don't know if the market's really rallying fully on a Trump victory. I don't think anything has been priced in. I'll just say that. And then, if anything, I think the VIX is at 20 because of the uncertainty, because it's a 50-50 spot right now. It really still could go either way. I mean, for me, 55-45, that's still 50-50, Brian. Like there's no clue, no certainty whatsoever who's going to win.
Yeah, that's right. I mean, look, the VIX at 20 obviously is an indicator. We talked about that before on the show, that first week of November, we've got the election, we've got an unemployment report, and we've got a Fed decision, all factoring in, driving volatility higher in this market. And the market just seems to climb this wall of worry of volatility, which is maybe a driver behind the rally recently.
Yeah, well, let's take a look at the volatility, Brian. Let's look at the skew.
Yeah.
We talk about this every week. This is, of course, this uses the S&P 500 25 delta call versus a 25 delta put. This measures how much more it costs to buy the put. And certainly things are a little more troublesome the more expensive the put is. It very, very strongly correlates to the VIX. And we kind of use this as a little bit of an indicator for our volatility trading models, something we bring up to highlight with you guys every week. And you can see we're elevated recently. I think we're kind of in a higher range. We will see this higher range for some time period going forward. But if you just kind of zoom in just on the past month, Brian, we had that blip here right at the start of October, kind of came off there. We're kind of cooling off there, and really we're settling in here. Finally, looks like we're coming down. It looks like volatility wants to ease here just a little bit.
Yeah, it does seem like it's coming off. We are starting to see some call buyers come back in the market. I don't think it's unusual. The last couple of day rally in the stock market has gotten people what I call giddy for the giddy up call to the upside, and people removing some of that put. So the skew's kind of shifted. And I think if the skew drops a little bit more, that would be a pretty bullish indicator. Our indicators also gave us a sell signal on the VIX futures contract, actually, just a couple days ago, where puts were almost overbid, volatility almost got overextended. And so from our separately managed accounts that we trade, we did get that sell signal to at least take off some of the volatility hedge that some of our accounts would have on. That's traded in Equity Armor. So full disclosure, we were a little bit bearish about whether volatility could continue higher. And so, personally, I think if we sort of break this level on the skew, trade like 5.1, 5-1 on the put versus call ratio here of the skew, it seems like it could head a lot lower back to where we used to be in 2023.
Yeah, and looking at it, just a little bit different picture. Let's look at the VIX futures here, Brian. We're at the red line, of course, is where we are currently. Last week, we were a lot higher, as you saw in that chart. Last week, we're higher in volatility. We've come down basically 2 vol points here, just cooling off a little bit. And we're still elevated, though. There's no question about that. And we got this is expiring on the open on Wednesday. So we got the October future expiring. So really, you kind of look at like the November future is about to become the front month, and now we have a spot where we have the cash above the front month, kind of in a pretty steep way.
Right. And so to me, it indicates that the futures in November, December, indicating that the VIX will sort of come off these levels, head lower. Maybe it takes that election as a catalyst to let people sell volatility again. But until that happens, maybe that VIX does stay elevated above the other VIX futures months. But certainly, with the going back, 1 and 2 months on the VIX futures curve, those points are obviously lower. We know volatility is mean reverting. The rubber band may be getting stretched too high with that green area of a week ago. So maybe those 2 lower areas is something where the VIX futures could be headed in the near term future.
Yeah, so we got major event risk happening in the November cycle. Maybe after that event happens, that future will still be on the board. Futures traders are betting that volatility will come down after that. Even if there is a big volatile event, volatility will be down by the time November expiration rolls around, which will be about 2.5 weeks after, 2 weeks after the election.
Yeah. So yeah, we'll see where that goes. But I think this kind of leads towards, if volatility comes off from these highs, if it looks like there's maybe some more call buyers, I think we should look at the S&P chart, Joe, and see where that thing is going.
Great idea. Let's look at the S&P chart. We got it queued up here, of course, for you guys. This is a 6-month chart here. Of course, the market's been in a huge bull run for 2.5 years here. The 6 months been no different, and really just continues to climb this incredible wall of worry. Like everybody's talking about how this economy appears to be slowing down, how there's so many bad things out there, and yet the market just continues to chug along.
Yeah, it really does. And when you look at this sort of kind of made like a double bottom from this range, if you kind of look at that range, which is call it, 450 points, the breakout target to the upside would be 450 points. And so when you look at that, if this trend channel is a new little near-term trend channel, you're looking at maybe 6,100 on the S&P here to the upside, and it looks like that breakout is on.
Well, let's take a look at where that would put 6,100. If you go back to our 2-year chart, I mean, let's just, tip our hats to this rally here, Brian, dating back to September of 22. This is just tremendous. We were all the way down here, 3,600, and now we're at, 5,750. That's just a tremendous 2.5-year run. And it looks like it wants to continue. And usually when you get runs like this, it continues. It's longer than a couple of years. So let's just enjoy it while it lasts, I guess, is to say. And that 6,100 is going to put us all the way up here, like we have pointed out there. So that would be just another nice little bonus here.
Yeah, well, I mean, doesn't this chart show you how bad it is to be in bonds? I mean, you think the world is coming to an end, even if you're getting 5% interest on fixed income, let's say. When you look at what the stock market did, there's so many strategies out there that either, predicate on high yield, get some yield somewhere, sell a call to bring in yield. All that gets called away or misses upside to the market. And really, if you're tentative, don't go all, I wouldn't go all in on the S&P, but it seems like where your growth on your money is in the equity market, which has the true growth in here. And, maybe you set some cash set aside instead. I mean, obviously our hedged equity strategies that we run have done very well in this kind of market environment that predicates on long volatility, upside moves, wing moves to the upside, wing moves to the downside. But these wing moves that happen just seem to come more and more. And you're seeing that over the last couple of years, in the last 6 months. And that rally is nasty.
Yeah, it looks even more dramatic when you look at the tech. You look at NASDAQ here. Just incredible, run. Like basically off of the charts. This does not have that. That's not the right price of the Nasdaq there, obviously, but that is just a fantastic recovery here. And the Nasdaq is not quite on an all-time high here, Brian. We'd love to see it there. I think it's got a chance to hit that spot, and I think if it does, it will be because of the semiconductor index. Just another index, just been a 2.5-year run of just insanity. Let's see, we were at like 80 up to 256 is just incredible, Ryan.
Yeah, well, and all that obviously is part of the whole generative AI boom that we're seeing. NVIDIA here pushing on all-time highs again. So that's, moving SMH higher, but some of the other names participating because it seems like other areas of the semiconductors will get into the game in some fashion, be competitors in some way, form or another. That whole web of AI is continuing to boom. And you look at a SMH, it looks like it's kind of been making like this little double bottom breakout, cup and handle kind of formation where maybe now it's ready to go retest those all-time highs again.
Okay, so bottom line is there's no fighting these trends, Brian. They are going higher. And that is just in the face of, and maybe in spite of, or maybe because of all of this just troublesome news. We talked about it off of the open. We got unemployment rate just starting to creep higher, right? I mean, I know it's still very low on a historical comparison, but it's going higher. And that's very troublesome because it doesn't usually stop and like turn around. Hopefully it does, but usually it tends to get worse before it gets better. And we also have the job openings here. So the job openings are basically go hand in hand with job losses. There's fewer jobs available, and people start companies want to hire people less. And then the next thing they'll do is they'll start firing people that they already have employed when things get a little bit tighter. So it won't be surprising to see that the unemployment and the jolts are very highly correlated. And we had a really, really nasty sell-off here in the jolts. And we have not really, we've seen a little bit of job losses and the unemployment. We have not really seen that pick up in a big way. So here is it looking at it another way. If you go back to 2007, you had this jolts do that and really steep losses in jobs. You had the jolts do that in 2001, very steep job losses. So we had yes, it did happen in 2019 and obviously very, very steeply in during the COVID era. But yeah, here we are today. We have this big reduction in the jolts. Are we going to see the losses a comparative comparable amount of losses in the future?
Well, I think this is why, we saw some Fed minutes and basically the Fed governors, it was a 50-50 mix of people who wanted a 50 basis point drop this last meeting and 25 basis points. I think those that were on the side of a 50 basis point drop in rates basically are looking at probably the jobs, the jolts, openings, and saying there's a pretty high correlation here. If we can't get openings to start to increase, then our unemployment rate is at jeopardy here of moving higher, even though this last report kind of was stable, which was a pretty good sign. If we get another stability of unemployment here where it's not ticking up, I'd be a little bit more bullish about it. But when you look at this sort of correlation, this is the reason for the Fed to cut rates and be in an easing mode. And then, of course, if that's the case, then what happens? Well, you likely get a rise in the stock market because valuations could go higher with cheaper interest rates, making it easier to borrow. But we're also in a cycle of elevated volatility when you look at interest rates in the near term versus the long term. So that all plays into a big part in just seeing market movement, whether it's the 1990s or 2007 or 2001, like you showed there. There's going to be more volatility in this market.
Yeah, well, that's where we are. The VIX being at 20. One thing that we talk about a lot, though, that isn't really being, I don't think, talked about enough, is this time is different only because like the government has changed so much. The government's doing a lot of the heavy lifting when it comes to the GDP. The GDP has been fantastic lately, but the deficit spending the government's doing is really off the charts. Even if you look at like World War II spending, the deficit spending is just astronomical. So it's for me, it's just a layup. The economy is strong because the government's doing so much. I don't know if that's a long-term solution or a long-term outcome that is going to be able to stick around forever. But for the short term, as a portfolio manager, just seeing these charts go higher, just seeing these earnings, continue to accelerate. There's no other choice but to be invested in this market because everything's going higher.
Yeah. Well, speaking of being invested in this market, what do you got for me? ASML, this is maybe a name to play the market going higher, right? Because here's a high growth name. It's in every part of the industry. It's a factor in all ways of life of chip development. Joe, earnings this week, you got a trade for me?
I do, yes. ASML, we've been talking about this name for a long time. In fact, when we started talking about AI names, almost a year ago, Brian, this is one of the first names we brought up. You cannot get these chips without ASML. So like NVIDIA like designs the chip. They don't produce the chip. TSMC produces the chip. But the thing that makes the machines is made by ASML. They advanced lithography. I can't even explain it all, but they have very high tech machines. It's impossible to get into this market and to be able to compete with them. So they essentially almost have a monopoly on being the company that builds these machines, that makes these chips, which everybody needs for this AI trade. They've come off a little bit on their chart recently. I have just a trade just designed, developed to take advantage of an upwards move on earnings. Historically, Brian, it moves about 3.5%. If you look recently, it moves a little bit more. The market's betting on a 5.5% move. So this is with ASML close to 870. I'm looking at a call butterfly. This is me kind of like calling my shot here, picking a strike I expect it to go to. That'll be my max gain. We'll be right at the middle of the butterfly. And it would be a call butterfly. It costs $8.45 for me to put it on. So that's not cheap, but it's a very, very nice return all the way up to $41.55 if we do settle in right there perfectly at $9.40. Now that's very unlikely for me to just be able to wait until the close on Friday to take it off right at $50. More than likely be taking it off Friday morning if it is in my favor. But still, that's how the trade looks out. Again, I talked about the implied move and the recent earnings. I have just a quick chart of that here, Brian. We can see recently, it's moved downwards 13, 7%, 8%. So it's had some bigger moves lately. I think I'm hoping for that 6-7% upside move would be right in that sweet spot for me.
I might treat this like, maybe 0.5% of my portfolio in the value of the cost of the butterfly, right? So, with that 5-to-1 payout, I'm trying to make 0.5% turn into a 2.5% in just a matter of a very short time. And if I'm wrong here, it's a much better way to play ASML, I think, at this point. You look at those trend lines at 940 strike is what we picked as the short strike, where the max value would be gained from the butterfly come Friday. So it does get a little tricky if the stock trades up to there prior to the actual Friday afternoon expiration for it to sort of settle in and be at that price.
Well, it's got a very long delta. If we're trading there before earnings on
Yeah.
Thursday, I'd be happy to take it off for a winner. Absolutely, there's no question about that, because anything can happen on the earnings. But yeah, I think this is me betting on upward move on an earnings, not a blowout upward move, because it's not going to make any money if it goes to 1,000. So I'm not expecting that on this earnings. Just expecting a nice upward move, get into this sweet spot here, and then that will be at least a 2 or 3x winner if we get that Friday.
Yeah, that's right. And like I said, I think maybe the one risk here is like you blow through the 940 strike up to 1,000. Let's say the stock makes maybe like a 2/3 retracement from that 1,100 mark down to 750. So the 2/3 puts you maybe a little bit closer
Well,
towards 1,000.
the break even on the upside, of course, is going to be it's going to be 780 or not 881. So it's pretty good still.
981, you should say.
981. Yeah, it's still pretty good.
Yeah, you still
So
got some room.
I got some room up there for sure, which it still looks very good for me.
Yeah, and with the average implied move of 3.5%, obviously to get to 1,000 off of this move would be massive. So, I think the risk reward is there to put this on, and this is just this is what we do every week. We try and find better risk adjusted returns in investing in this market using options to express that interest, and this might be one of those.
Yeah, I mean, to put it another way, you could argue this is like 50-50, it goes up or down. I think it's better than 50-50, it goes higher. That said, this trade is like 4-1 in my favor if it goes right. So I'm getting 4-1 odds and something that's a 50-50 probability. I really like that. I really like that setup.
Yep. All right, Joe. So do we have any other questions here on the show?
I do have a question.
Oh.
Someone was asking about ASML. Why do we choose them compared to other companies involved in chips? We're doing an earnings trade this week. This is an earnings trade idea I'm interested in looking at. We do own ASML, full disclosure, for clients. We do think it's got a moat, being that it has a monopoly in being the company that makes these most advanced machines that make the most advanced chips. So it's very hard to get into. We got the chip spill in the U.S. There's a lot of money still to be allocated yet for that. People are making more chips, and they're going to be making more chips next year, and they're going to be making more chips the year after that. This is not a trend that's stopping anytime soon. And just, the smaller these chips get, the more chips they need to make because they can just take up more space, which is just a crazy, crazy thought.
Yeah, sure. All right. So folks, look, we're running out of time, Joe. We got to let people get back to trading. We got to get back to trading ourselves. It's been a great show. Make sure you tune in every Monday, 1 p.m. Eastern here on the Trading Zone, sponsored by the MIAX. I'm Brian Stutland of Equity Armor Investments. And
I'm Joe Teague of Equity Armor Investments. Hope you guys have a great week. We'll see you next week.
All right. Peace out.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.